There's a debate going on whether or not so-called market concentration is something that investors should worry about. The largest 10 companies in the US represents around a third of the total market capitalization. In fact, these companies are so large that if they were to be their own stock exchange, it would be the second largest in the world. Now, does this really matter? What about other countries outside the US? Have we seen similar levels of market concentration in the past? And if so, what happened to stock returns? So I will answer all of these questions in this video as I will go through this debate whether or not market concentration is something to worry about. But first, make sure to drop a like and subscribe to support this important channel. Now, there are various ways of defining market concentration. One of the most simplest way is to look at the share of market capitalization that comes from only, let's say, 10 companies. Now, this is how it looks like for the US, 27% coming from the so-called Magnificent Seven. Now, actually, there are more concentrated markets out there. Of the major global stock markets, market concentration is actually lower in the US compared to most markets. Now, this is my channel, my video, so we're gonna include the Nordic stock exchanges as well, whether you like it or not. Denmark has the highest concentration since the market basically consists of one company. So these plots are fine, but I don't think it's that accurate to compare different stock exchanges that have vastly different number of stocks. Think of Switzerland, for example. Switzerland has like 200 stocks and the US has thousands. So taking the top 10 from the US, top 10 from Switzerland, it's a bit different. So what I prefer to do, and you can correct me if I'm wrong in the comments, but I like to use percentages. So let's look at the top 1% of each stock exchange and then we do the comparison. Doing this, the US is still not the most concentrated market, but it is still among the highest of the pack. What we can also do is look at the top 10 versus the 500 largest stocks. And let's do the same with Europe as a whole, not the individual markets. Historically, today's concentration in the US is high, but it's not completely unprecedented. We have seen higher levels in the 60s when AT&T was the largest company. And if you're interested to see how a strategy that picks the largest 10 stocks, I made a video about that as well, including a backtest that you should check out. Now, what I'm about to show you explains why some people are worried about this. Historically, when market concentration has peaked, forward returns tends to be lower than average. This plot adds the total shareholder return for the S&P 500 in periods in rising and falling concentration. For example, the decade after the dot-com bubble, S&P 500 had just 3.6% annual total return versus a long-term average of 11.4%. A more rigorous analysis of this comes from Goldman Sachs, who recently lowered their long-term outlook for the S&P 500, mostly stemming from the high level of market concentration. Their model is forecasting an annualized return around 3% for the next decade. So this is in stark contrast from 13% we have seen from the previous decade. If history is any guide, their model suggests that we would expect lower returns from market cap weighted indices like the S&P 500 for the next decade. And one variable that drags down this estimate is the current level of market concentration. So the intuition behind all of this is that in the same way that it is difficult for one company to maintain high levels of growth and profitability,
you got no idea what it's like to be number one.
The same holds true for an index that is concentrated in just a few stocks. So this lack of diversification coupled with stretched valuations has in the past led to lower long-term returns. So it's kind of like don't put all your eggs in one basket kind of argument, unless you're Mark Cuban.
Diversification, that's for idiots, right? Because you...
Now, for some perspective, here are some arguments for why market concentration as a measure is a bit flawed. Remember I mentioned that AT&T was at a time the largest company in the US. AT&T was seen as a monopoly that later got split into 7 different companies. So overnight, your measure of market concentration would fall. And this is relevant today because you have the Department of Justice pushing for a breakup of Google. Now, if this were to happen, our measure of market concentration would fall, but in the buy and hold portfolio, I don't really see how it would be less or more risky if we were to have a large allocation to a big conglomerate than having the same allocation split between 7 different companies. In fact, one could argue that having a big allocation to a monopolistic conglomerate is less risky than having the same allocation split between different companies that are all competing with each other. And taking a closer look at the top 10 largest companies in the US, you will see that they are very diversified, both geographically and also in terms of their businesses. All Magnificent 7 companies has a higher share of revenues coming from outside the US compared to the market. Although expensive, you're putting some really nice looking eggs in big baskets. Okay, that's my last eggs metaphor, I promise. If we can show that more and more value is being created by these handful of companies, having a higher concentration in these companies might be justified. A company is said to generate value if it's able to earn a return on its available capital that is higher than the cost to finance that capital. If the company can take that capital and generate more money than is required by the capital providers, the company is generating value, so-called economic profit. Now, figure out what is required could be an entire video of itself. According to Morgan Stanley, during the past 10 years, the increase in market cap concentration among the top 10 stocks has been associated with an even larger concentration of economic profit for these same stocks. They have been earning a return on capital way above its costs. And since stock prices should be a reflection of the market's view of economic profits in the future, having a high concentration of these companies seems to be justified by these fundamentals. Valuation is also why I don't completely buy the Goldman Sachs paper. So their definition of valuation is to look at a price to earnings ratio, so a PE ratio.
Actually, it's a CAPE ratio where they smooth the earnings over 10 years and adjust for inflation.
Bro, it's a PE ratio.
Oh, I adjusted for inflation. Oh!
And the forecasting power of the CAPE ratio has diminished over time. So when Goldman Sachs says that their model is most sensitive to this variable, I'm a bit skeptical of the output. And if history is any guide, in the next 10 years, we will probably have new names in the top 10. Growing companies that are even more profitable will replace the less successful ones, which we have seen over the history. And new companies being included in the index means that forecasting out 10 years from now could be quite difficult. Summarization. We can observe that over the long run, high levels of market concentration has been associated with lower forward returns historically. With long-term returns, they mean 10 years. So that's important to emphasize because they did not find any relationship between stock returns and market concentration when you look at returns over months or years. High concentration leads to less diversification and higher volatility, the argument goes. Now, the other side of the argument would say that US is actually less concentrated than other markets, and we can see that levels of market concentration in the past have looked similar. And market concentration by itself is not a great measure of risk. And the concentration we have seen seems to be a bit justified by looking at fundamentals, which in the long run matters more than just market concentration. Concentration is just a logical conclusion of having a handful of companies earning a sizable profit that the market puts a premium on. Of course, we can have the debate whether or not the market is extrapolating a bit too much of the good times we have seen in the past. So this might very much be the case today. And the model from Goldman Sachs is just a model, right? They put a lot of emphasis on past historical relationships between valuation ratios and market concentration. And this relationship might not exist in the future. So anyways, I think this is a very interesting debate. So I would love to hear what you think in the comments. And I'm gonna make a short follow-up video for what actions one could take dependent on where you fall in this debate, but I didn't have time to finish it, but that's gonna come up later. But until then, make sure to like the video and subscribe, and I'll see you next time.
No voi vittu mikään onnistu, kun saatana jää korkikki vittu käteen.